Hello, everyone, and welcome to the Cashflow Connections. Let's try that again.
Red
Gotta
leather,
love
yellow
doing
leather. Red leather, yellow leather.
gotta love doing the live intro, dude. All right, here we go. Easy peasy. Hello, everyone, and welcome to the Cashflow Connections Real Estate Podcast. I'm your host, Tyler Lyons, and I'm very excited for the guest that we have here today. He's a CPA, real estate investor, and founder of Stonehand, where he manages over $20 million in assets and advises real estate businesses on tax, accounting, and capital strategy. With over 15 years of experience and background as a CFO for a $1 billion real estate investment firm, he brings sharp insight into deal structuring, investor relations, and financial leadership. James Bohan, welcome back to the show.
Tyler, excited to be back on here. There's a lot of exciting things to talk about.
There definitely is. And as we think about the one big, beautiful bill and how that might impact real estate investors, I couldn't think of anybody better to bring on than you. So it's good to see you, my friend. Super excited to dive into this here today and start to demystify what this means for investors. Of course, feels like there's a lot of good in here for real estate investors, and we're going to dive into the details here and really unpack this for the listeners here today. So before we get into the kind of the deeper mechanics of this legislation and what this means for real estate investors, let's start kind of macro level here, James. So broadly speaking, when you kind of look at the totality of this particular legislation, what do you think this new legislation means for investors in the commercial real estate market at large? Seems like it's probably pretty bullish, but what's your perspective?
Yeah, good question there. So I think one of the biggest things for people to understand about this bill is it's a very populist bill. The other thing is that it's also very big. When it says one big, beautiful bill, they are not lying about that. It is definitely a big government bill. This is not your daddy's Republicans type of bill where they're slashing a bunch of government. This is a big government type of bill, and they're really trying to um, create policy with this with a lot of the tax changes in here. And overall, I think at least in the very near short term, this is going to be incredibly bullish for the economy, for commercial real estate. There's a lot of great things in the bill. The quote unquote bad things in the bill, in my mind, are is that it's drastically adding to our deficit. They auto expanded, our debt ceiling by 5 trillion, so they don't have to fight every, 6 months to increase it. So that could have some long-term effects on like the credit worthiness of the US dollar. And, everything kind of gets priced off 10-year treasuries. And if we continue to be this drunk debtor, Uncle Sam nation spending, 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 on the long term, we can maybe see some negative headwinds of this bill, but right now, a lot of the kind of like the immediate changes, I think, are going to drive to a lot more investment, a lot more real estate transactions, and give people a lot more certainty. The last Trump tax bill that we had, a lot of these things were scheduled to sunset at the end of this year in 2026. So getting this bill passed and getting a lot of these things made permanent, I think is great because investors and people deploying capital like certainty.
Excellent. Yeah, that's really helpful, kind of just a broad perspective on that, James. And yeah, when you think about even the name of it, one big, beautiful bill, I guess beautiful is in the eye of the beholder when you think about the fiscal deficits we're running and that piece of it. So, agreed with your perspectives. I think near term here, it's going to be very bullish. But in terms of the long term perspective, it's definitely going to be something that we want to watch closely in terms of what those deficits are, the credit worthiness of the U.S., saleability of the bonds. I think the longer picture is kind of an interesting one.
Yeah, and I mean, just kind of looking globally, we're in a competitive global market. The dollar has, lost what I think 8% value on the year compared to the euro, if not more. But all the other countries are in a similar debt to GDP situation the US is. And, if anyone's read Currency Wars by Jim Rickards, we all just take our different turns, printing and devaluing our monetary supply. And I guess right now it's the US's turn to, kick the can further down the road or expand our debt limits. And, I mean, Europe and Japan and other nations debt to GDP situation, isn't that great either. And,
Yeah.
the US ends up being the least worst when you look at it that way.
Yeah, it's kind of the typical clean a shirt in the dirty laundry sort of analogy, right? So totally
Exactly.
hear you there. And when you look at the legislation here, James, kind of bring it back to that, one thing that is getting a lot of buzz, like we've got a deal that's going to be coming to market pretty soon here, and I'm having some early investor discussions, and it's coming up quite a bit already. I think people are pretty excited about this. But bonus depreciation is kind of coming back in a big way here. Help us understand what's changing with bonus depreciation.
So, this is what has our industry extremely excited is that 100% bonus is back and it's now permanent. And really what that means is, and we'll get into the real estate analogy here. If you buy like a piece of equipment, anything that has a depreciable life of 20 years or less, and you've acquired it after January 19th and placed it into service after January 19th, in January 19th, why January 19th, 2025? Well, because Trump was inaugurated on January 20th. So you'll see this kind of throughout the bill of him trying to leave his mark out there, being like, hey, remember what I did for you, and this is kind of like why that date was in there. So let's say you buy, a $10,000 piece of machinery. Well, you can use bonus depreciation right off that $10,000 in year one of when you bought that machinery, so long as you bought it and placed it in the service after, January 19th. And so what that means for real estate is when you're buying real estate, you're buying more than just, the building and the land, you're buying all the components of the building too. And maybe a really easy way for people to think about this is like a hospital. And, this is where the cost segregation court cases defense kind of came out of, is these healthcare REITs were buying these hospitals and they're looking around and looking into the walls and like, there's all this machinery in the walls in a hospital, specialty, life-saving equipment in there. And what they did is they ordered a study in what we call a cost segregation study or a cost seg study. And they were able to segregate the costs of what they built. And so they're able to segregate the cost for the land, the building, and then within the building, like all this specialty equipment, in real estate, land improvements are 15-year life. So by doing this, you're able to ascribe the different IRS depreciable lives to these different components. So commercial real estate is 39 years, but this specialty equipment might be 5, 7, 10, 15 years, and land improvements as well. And these lower year class lives are subject to bonus depreciation. So generally, when you're buying a building in multifamily, you can write off 25 to 35% of the purchase price in year one with bonus depreciation. And, you really have to get a study, get the estimate, depending on how much you're leveraged. That can mean, it's like 70, 80% of your investment can be written off in the first year. So this is incredibly attractive to real estate investors. And now you also want to be able to take these losses. So if you're just passively investing in a real estate project, you can use this depreciation to offset other passive income. And now if you're a real estate professional, you qualify for that. There's various rules there, too long to get into on this, podcast right now. You can take these depreciation losses and offset, W-2 or other active income. So this bonus depreciation is incredibly incentivizing to people to transact in real estate to get this bonus depreciation.
Yeah, super helpful, James. So you buy a real estate asset because of bonus depreciation. It's not that you can just buy it and all of a sudden like, hey, good news, 100% bonus depreciation. I can just write this whole thing off in year one. You kind of go through a process of kind of segregating those costs. And as a multifamily owner and operator, we actually hire firms to come in and do these studies for us, but you segregate the cost between here's the value associated with land, and here's the value associated with furniture and fixtures, and here's the pieces associated with the actual building. And then you depreciate them based on those various different lives, right? So, kind of high level, that's how it works. When you think about the different components here, I broke it down kind of high level there, but can you provide maybe just a little more color in terms of what those components are, whether or not they're depreciable, and what the depreciable life is?
Yeah, yeah. So let me just kind of get me off the cuff here. So let me think about it through. So when you look at all the different components, like I said, there's land. Land is not depreciable. The building, if you're in commercial, 39 years, resi, 27 and a half. And then like if you're buying a hotel, for example, you're going to be buying a lot of personal property in there. And that could be 5 to 7 year life for furnitures and fixtures. Um, Now, if you're buying a farm, for example, there might be a lot of fences on the property, and then fences and land improvements. The land improvements are anything God didn't put there. So, we have fruit trees on our farm here too, and so fruit trees were identified as, I think, 10-year life property. And so on a farm, for example, you write off all the fences and the agricultural trees with 100% bonus. So that's kind of some examples of how you kind of go in and look at the different components. And like I said, like in a hospital, all that specialty equipment could, to be depending what it is, 5, 7, 10 year property too. And you can elect to expense all of that with bonus depreciation.
Super helpful. Super helpful. And this is one of those things where it'd probably be easier if we could like show spreadsheets and that sort of thing. But for the benefit of people who are just kind of listening here via audio, let's just take kind of your typical, bread and butter multifamily real estate investment. So sponsor buys a multifamily deal, modest value add component, long term fixed rate debt. They do a cost segregation study and kind of chop up those different pieces of the cost so they can appropriately depreciate the property and pass through the maximum tax benefit to the LPs in that particular deal. So if somebody is an LP in that particular deal, uh, let's say it's a 5 year business plan, like what might that look like for them? Is it basically a write off in year one? They can kind of carry forward some of those losses. Then when they sell at the end, you've got recapture. Like at a high level, maybe kind of walk us through just like what that might look like. Appreciate we don't have a ton of deal specifics here, but just maybe give us like a high level feel for what that might look like.
Yeah, just to maybe think about things simply, and this can be some large generalizing statements, and everyone should look into their own tax situation with their own tax advisor, and each deal has to be modeled out because everyone's a little different.
For
But
sure.
generally, what it means is like in year one, you invest in the property. Let's say you invest 100K through a syndication. Depending on the economics, how much it's levered, you might get a K1, which is basically like a W-2 or a 1099 to report your investment taxable income. So you might get this K1 that shows like a $30,000 to a $70,000 loss in year one. And that's not like a real, just generally not a real loss if the operator is doing their job. That's a paper loss. And so these paper losses with depreciation, usually for the first, 4 years while you're holding the property, the depreciation will generally offset any of the taxable income, owed for the rental income portion. Now, when you go to sell it, you do have to recapture what you took as bonus at ordinary rates, and then anything that was depreciated over that 27 and a half year life gets recaptured at 25% rates. And so, the bonus really helps lower your taxes in the first year, and the depreciation helps minimize it on the cash flow. But you end up due paying taxes or getting the capital gain in that year of disposition. And what I really see out there in the industry is people doing what I call like lazy 1031 exchanges. When you're in a syndication, it's really hard to 1031 that as an LP. But as you get your proceeds out from the year of disposition, if you just roll that into another deal, then the gains will come in this year, and then the bonus depreciation from the new investment will come in and really help to limit your taxes owed in those years of those big gains from like say the first syndication. And so that's something we coach with our clients, and we kind of look at the whole picture and we're like, hey, we have these gains coming here if we invest in this syndication. What does that look like for our tax picture?
Super helpful. And in terms of the depreciation losses that might flow through the limited partners, if you're an LP and you're looking to invest, just be careful in terms of thinking about the benefits of these losses because I mean, if I'm an LP, James, and I'm not a real estate professional, I can't take that depreciation loss to just offset my active income. Let's say I'm a doctor and I'm not a real estate professional. I can't take those losses and just offset my income for being a doctor, right?
Well, maybe what does your wife do, Mr. Doctor? Is your
There
wife
we
a real
go.
estate professional? And then what, Mr. Doctor, like, are you invested in any other businesses as well, too? Maybe you're a doctor, but you invested in someone else's practice, but you're actually not actively managing someone else's practice, and you have a bunch of passive income from your doctor buddies. Maybe he's
Oh,
an eye
yeah.
doctor and you're a heart doctor, and you've invested in his eye doctor business, and now you have a lot of passive income coming from that. So the passive income coming, the passive losses coming from your real estate business can help offset some of your other, you know, uh, broader portfolio uh, holdings.
Super helpful. Yeah, so basically then these losses that essentially if you have passive if you're investing in a syndication and you're getting bonus depreciation, if that's a passive loss for you, you would need to find other passive income to be able to kind of soak up those losses essentially, right?
Yep. Yep. And a lot of real estate debt funds, if they report their income properly, in my mind, can qualify to be reporting passive income to people. So if you kind of pair a debt investment with an equity investment in real estate, it can lead to a great, beautiful tax result.
Excellent. Love that strategy. So we covered bonus depreciation in quite a bit of detail there, James. Let's talk about some of the other elements of the one big beautiful bill as well. What about deductibility of interest? I'm hearing some buzz that there could be some changes there. What do you know about that particular piece of the legislation?
Yeah, so I think you're referring to 163J, and kind of
Yep.
how it was before is very, very high level general. You could only deduct interest up to the extent you had income. Unless you were a real estate business, then you can make an election out of that. Unless you were a tax shelter, which most syndications are, then you had to go back to ADS life. So it's been something we've been managing around a bit. But the biggest change here is that they basically took the income threshold and looked more at EBITDA than just net taxable income. So they don't limit your interest deductions by looking at depreciation, amortization, all that. Now it's kind of more on a EBITDA level to limit any potential interest, and any excess interest expenses carried over to future years.
Got it. So if I were to say that differently, then it sounds like if it went from a EBIT or net income number and it changed to EBITDA, essentially that's a higher income number, right? So does that give you a higher amount that you can potentially deduct? Am I thinking about that right?
Yes, exactly. That's a great way to reframe what I said in a more palatable way.
Right on. Helpful. Yes, that could be big for investors then, for real estate investors then, if we can deduct more, we can deduct more interest. Obviously a lot of these real estate investments are leveraged investments and we love leverage and the some of the tax benefits that flow from it. So it seems like that could be pretty helpful and pretty pertinent for the investors out there.
Yep. Yep. And then the other thing is how it kind of might shake out is, um, like I said, how we've been working around it for syndications to not get interest expense limited is by, like I said, electing ADS life for the building. So we'd move the depreciable life of the building from 27 and a half years to 30 years in multifamily. And if we don't have to do that anymore, then people are going to get, about 10% more depreciation on the building portion every year.
Got it. Makes sense. A couple other ones here too that I want to touch on really quickly with you here, James. So another area that's been really buzzy in the world of commercial real estate the last several years here is qualified opportunity zones. So in terms of qualified opportunity zones, they've been out there for a while. I think most people have a pretty decent flavor for what qualified opportunity zones are, at least have kind of heard of them. In terms of the impact to qualified opportunity zones by this legislation, I think there are some changes there as well. Is there anything material that kind of happened to the qualified opportunity zone legislation as a result of the
Yeah,
big, beautiful bill?
absolutely. Pretty excited about this. Couple major changes we'll highlight is one, the program was made permanent, and kind of how we're talking about this is we have opportunity zone like V1 or version 1, which is kind of what we're operating in through 2026. And then we're going to get to the permanent opportunity zone regime, which will start in 2027. And kind of the general changes there is with an opportunity zone, you can only invest capital gain money to get your advantages. And I'm going to talk all about op zone V2 instead of V1 here. And then on a rolling 5-year basis, so you invest capital gains and you defer them for 5 years on a rolling 5-year basis. In V1, if you invested capital gain money, you deferred the tax until 2026. So it was a fixed date. Now in the 2027 regime, we have a rolling 5-year deferral. Um, and you still will get a 10% step up in basis. So if you bought stocks for 100 and sold them for 200, you'll get a step up in basis from 100 to 110. So you pay tax on 90 gain instead of 100 gain. And the other big change is Trump rewarded a lot of the rural voters out there and increased the step up in basis for rural opportunity zone funds to 30%. So in that same example, your 100 stock basis goes to 130 on a 200 sale. Now you're paying tax on 70 instead of 90 with a 10% step up or 100 with no step up. So those are kind of the biggest ones out there. There'll be new zones designated for 2027. They did increase kind of the threshold of what can qualify for an opportunity zone by making sure the threshold was lowered from 80 to 70% of median family income to qualify a zone to be eligible for an opportunity zone. And then the governors of all these states will put together their maps every 10 years and redesignate every 10 years. So these were kind of some of the big level changes of moving into Op Zone V1 to now this permanent program that will really start in 2027.
Awesome. Yeah, I love it. I think it's great legislation, and it's definitely seems to be working too in terms of driving some development in some of these areas of the country that could really need it. And I give some kudos to Scott Turner too, the new HUD leader. He's an industry guy. He's been in the world of real estate. He kind of knows what's up. He knows what works, and it seems like there's some good things going on over there. Let's talk a little bit about the qualified business income deduction as well, James, because I think this is another area that's changed a bit because of the one big beautiful bill. What's changed here, and how might investors benefit?
General high level, no changes here. And this was one thing that we really kept our eyes on because this can be some people's, biggest deduction here.
Mm,
And kind of, I always like to harken back to the reasoning of why these things came in. And so essentially with the last tax bill, we lowered the corporate tax to about 21%. And so if you're at 21% corporate, but about 37% as an individual, well, what they did to kind of make that balance out and be at parity is said like, hey, your partnerships, your S corps, as you pass income down to the owner, they can now take a 20% deduction on that income to try to get you closer to that 20% range.
got
And
it.
since what also did not change was income tax and capital gains and corporate tax rates, it just made sense to keep this uh, parity, fair balancing pass-through deduction in. The only slight change was they improved the phase-out limits for some specialized service trades or businesses. Um, but that's like a really small thing. What was really cool was we really were able to keep all of this. Some other things that didn't change with the tax bill, like I said, the tax rates did not change. Carried interest did not change at all, and we still have our section 1031 like kind exchanges. So, more things kind of stayed the same and were made permanent with this bill than really changed. As a tax professional, there was a lot of changes we had to learn and implement from, Trump tax bill V1. Now we've all learned it, and this OBBA bill or ABBA, I don't know what people are calling it now. Um, didn't change that much, so it's great to see, like I said again, that certainty and locking in these previously temporary Trump tax bill V1 into the permanent OBA.
Awesome. Yeah, and the qualified business income deduction too. It is a big deal for real estate investors too, because a lot of investors do use these pass-through type entities to structure their deals, right? So I think it's a very pertinent topic for real estate investors. And kind of as an aside here, James, when you talk about some of these changes being permanent, I assume you mean there's not like a specific date when it phases out, because I'd assume if a couple years from now, if the Congress changes or whatever it might be, there or a couple years from now we get a different president, there could be different regimes that come in and try to undo some of this stuff. I assume you mean there's just like not a scheduled end date for it, but of course if a new regime comes in they could try to pass legislation to undo some of this stuff. Am I thinking about that right?
Excellent point, Tyler. Yeah, when we say permanent, compared to the last one, like I said before, a lot of these provisions or tax cuts were set to sunset in 2025 and 2026. The biggest one was the estate tax exemption was supposed to go down to like the low $1 million range, but that permanently, until they maybe change it again with the new regime, but that permanently got bumped up to $15 million index for inflation. So when we say permanent, it's permanent until they change it again. You know,
Yeah.
it's we can plan with certainty without being like, oh, this pass-through deduction is supposed to go away in 2026 as an S corp or partnership still better than a C corporation, It really helps us do long-term planning for our clients and have certainty in that regard. But the government can always change regimes and change policies. And I don't know, New York's about to elect a communist mayor, so who knows what could happen in the future, and we can get the complete opposite of this as a tax code in 10, 20 years. Who knows? But for now, it's permanent.
Yep. Super helpful perspective there, James. As we start to wrap this up here, too, I've got one last topic I want to run through with you, and that is the state and local income taxes as well. I believe there are some changes here that could also benefit investors. What do you know about that, and what are you willing to share?
Yeah, there's once again changes and then no changes as well for the workaround. And so basically what happened with the last bill is they limited the amount of state taxes you can deduct as an individual up to $10,000. This is the SALT state and local SALT tax deduction cap. So that got moved up to $40,000, but starts to phase out as you make over 150 grand. What they did leave in though was the PTET, as we call it, the pass-through entity tax workaround, where all these states quickly adopted to this new regime of not having their residents be able to deduct their taxes. So what they did is say, hey, you can pay your taxes at the partnership or pass-through entity level. It will become a business deduction at the entity level that it passes through to you as like a line one or line two expense versus passing through to you as a withholding credit. Yet you still, as an individual, will get credit for the taxes paid on your behalf by the entity. So I'd say the SALT thing got better, and the workaround still remains to keep those be 100% deductible where possible.
Got it. James, this has been awesome, man. Super helpful, super technical discussion. But look, when it comes to understanding these tax rules and regulations and seeking to avoid taxes, like these are the tricks of the wealthy. It's really important that you pay very close attention to these rules and these laws and these regulations and try to do what you can to position yourself to reduce your taxes as much as possible. It's a really important conversation. So, James, really appreciate you coming in here again today. If people want to follow you and what you've got going on over at Stonehand, what's the best way to do that?
So I'm most active on LinkedIn. You can find me there just by my name, James Bohan, CPA MRED. I'm on Instagram, James Bohan CFO, and then our website is stonehand.com. That's stone like a rock, Han like Han Solo, Han not hand. Once again, stonehand.com. I'm James Bohan. Thanks again for having me on, Tyler.
Thanks, James. Really appreciate it, man.